Another question I love asking owners too is like, hey, what would you do if I gave you $100,000? Gosh, I need new doors. I need to repaint. Gosh, I got to resurface the parking lot. That's the kind of things that you can do with the money that we're saving you by eliminating or reducing your federal tax liabilities. And I was talking to this gentleman and he says, I love you guys because every 2 cost segregation studies I do on my self-storage facilities, I create enough cash flow for a down payment on a third one. If you're trying to grow your portfolio, okay, and you do cost segregations on 2 of your properties, you're going to create enough of a cash flow to put a down payment on a third property. That's huge. I mean, the impact of that alone is just amazing.
Hey, what's up, everybody? Welcome back to the Self-Storage Income Podcast. Amazing episode today. You guys be ready to take notes. This stuff that we're talking about today with CSSI, we've got Brian and Brian on the podcast today. We are talking about all kinds of strategies from a cost segregation and tax benefit standpoint that's going to allow you guys to go in there, take advantage of improvements that you're making to facilities, talking about the acquisition side, how to break out this depreciation piece to get accelerated depreciation and allow you guys to capture that. Depreciation, it's going to allow you guys to make the money and keep it. That's what you want. You don't want to pay a bunch of money in taxes that you don't have to. Depreciation is that non-cash expense, allows you to take advantage of all that. So these guys are just amazing. They're going to give you all the information that you're going to need to connect with them, to walk through this process with them so they can show you exactly what it looks like. And there's so many nuggets throughout this entire episode where they share things that people are just completely missing and overlooking that can add hundreds of thousands of dollars back in your pocket, which is life-changing, totally game-changing. Stay tuned to the end as well, where they talk also about succession planning and how these things affect either exits or succession planning and passing these things down to your family. With that said, guys, let's get to it. Take notes. Welcome back, everybody, to the Self-Storage Income Podcast. We have an incredible episode going on here with you guys today, and not confusing you guys at all, we've got Brian and Brian here hanging out from CSSI on the podcast. These guys are incredible what they do in the self-storage industry for self-storage owners, and I'm really, really excited to bring them on, let them pull back the veil a little bit, show you guys inside of what they do, how they do it, and some of the just incredible benefits that come from these services that these guys do and provide to self-storage owners and operators out there. So with that said, Brian, welcome, guys. Thanks so much for coming in and hanging out with us today.
Thank you for having us.
Thanks, Connor. Thanks for having us here.
Yeah, no, absolutely. Well, just first and foremost, let's just give everybody kind of a quick rundown of who you guys are, what your background is, and how you got into doing what you're doing today.
Well, Brian Liles, one of the 2 Brians. Little background on myself. I've been doing tax benefits with CSSI for over 8 years, and I just love working in the self-storage industry. We're always speaking at ISS, SSA's, Florida Self-Storage Conference, the Texas Self-Storage Conference. And then in addition to that, we always have a booth at these shows. So I've been working in this space for the past 8 years and just love it. And there's tons of opportunities for you as owners to create cash flow for yourself.
And my background's a little bit different. I've been with CSSI for coming up on 3 years now. Prior to that, I had my own consulting firm that did research and development tax credits and 179D energy efficient commercial building tax deduction studies. But I recently sold that business and joined CSSI so we can bring these services in-house to complement the cost segregation services that we mainly offer. Prior to that, I was an architect. So I really did a 180-degree career change from designing buildings to tax deductions for buildings.
That's amazing. So when it comes to breaking out all those components, like you know what the heck you can do there. So
yeah, I can read some blueprints here and there.
Yeah, that's incredible, man. So let's give people a rundown on what cost segregation is, what the benefits are, why people are using those things. Just some insight there to really give some folks an introduction to what it is and why people do them.
So cost segregation's been around for over 20 years. Basically, what it does is when you depreciate that building over 39 years. Okay. What cost segregation allows you to do is to accelerate components of that building into 5, 7, and 15-year asset life. Okay. So in other words, we don't have to wait the the full 39 years to get the tax benefit out of certain items within those 5, 7, and 15-year assets. So all we're doing is we're accelerating that money and getting it into our hands sooner rather than waiting a full 39 years.
And I guess this is it'd be a good place to start too. Like, give people an idea of what that means. Like, what is depreciation and what benefits of that?
Yeah. So when you depreciate something, you create an expense. Okay. And as we all know, expenses equals reduction in tax liability. Okay. The more expenses we have, the less taxes we pay. Okay. So when you depreciate your building, you depreciate it 1/39th. So over 39 years, you will have your entire building repaid to you in expenses or depreciation. Okay. So now it's important to realize that you don't depreciate. So if you go and buy a facility for $1 million, okay, you don't depreciate $1 million because we have to back out land. We cannot accelerate land. So what we do is, let's say we do research and you spend $1 million on a self-storage facility. We figure the land value is 20%. So our depreciable basis is $800,000. So that's where we start the depreciation from, is that $800,000 number.
All right, since I know my listeners are self-storage nerds just like me, I wanted to share with you some of the best ways that you can get started investing and owning self-storage. So you may not know, but I wrote a book that's hard to even call this a book. I mean, this is a manual. We're talking 400 plus pages, which include all sorts of information about how we have been in the self-storage industry. That's everything from how we got our first deals, to scaling, to buying deals in today's market, what's changed and what remains the same. This is an up-to-date book that shows you how the market has changed and how you can win today. This isn't simple, this is how you buy a deal. No, this goes into everything, including how you scale and create a self-storage business. You can get a physical copy, an ebook, or the audiobook, plus free access to bonus content at the end of each chapter. You can get it today. It's available on Amazon and other platforms in which you can follow the link.
And then what you guys are doing is you're saying, okay, lump sum, yeah, you can depreciate this asset, minus the land over that 39-year time frame, or you can have professionals come in and break out individual components and depreciate those faster. Again, highlight the benefits of why somebody would want to do that.
Sure. Yeah. I mean, listen, I love working again with self-storage owners. So one of the first shows I ever went to was at SSA, and I was talking to this gentleman. It was down in Florida, and he comes up and he says, "I love you guys," like that. I said, "Hey, great. Tell me why do you love us and everything?" He goes, "Because every 2 cost segregation studies I do on my self-storage facilities, I create enough cash flow for a down payment on a third one." So stop and think about that for a second. If you're trying to grow your portfolio, okay, and you do cost segregations on 2 of your properties, you're going to create enough of a cash flow to put a down payment on a third property. That's huge. I mean, the impact of that alone is just amazing.
Just absolutely incredible. There's not a lot of things out there in the world that you can do that with. And that's just, shameless plug here for self-storage and being that real estate and business combination to where, there's not a lot of businesses out there that you can take advantage of those kinds of economies of scale and those different metrics like that, and those advantages like depreciation. It's absolutely incredible to the degree that you can with self-storage. And that's to your point, having those expenses, the depreciation is that non-cash expense to where you get to make the money and expense it, but you're keeping the money. So it's not like an expense where the money's leaving the bank. You get to keep that money. And so, to the point of this guy that you're talking to, that's like, man, every couple of these I do, I'm able to keep enough money in the bank to be able to go out and buy more facilities, which is just absolutely incredible, because otherwise, you'd be sitting there giving it to the government, which,
Right.
We don't like.
Who wants to do that? Who wants to pay taxes?
We don't want to do that.
For sure.
Exactly.
So another question I love asking owners too is like, hey, what would you do if I gave you $100,000?
Yeah.
I think, oh, you're getting me $100,000. Well, let's see here. You know what? Gosh, I need new doors. I need to repaint. Gosh, I got to resurface the parking lot and everything like that. That's the kind of things that we can do that you can do with the money that we're saving you by eliminating or reducing your federal tax liabilities.
Hmm.
I think the other great thing about cost segregation is not only is it a federal, so you can use it once a year. Okay, if once we create those tax benefits for you, you use it at the end of the year. It can also go against your quarterly taxes. So if you pay quarterly taxes, you can use the benefits from cost segregation to go against those as well.
Yeah, no, that's amazing. What else have you guys seen strategy wise?
So, from a strategy of, there's another tax benefit out there called 179D energy tax deductions. Okay. So, cost segregation takes everything and accelerates from 39 years to 7 years to 15 years or 5 years. Okay. 179D is the energy tax deduction. Okay. And Brian, I'm going to flip it over to you and let you talk a little bit about that and tell the people what that's like.
Sure. So the 179D is based on the energy efficiency of the building itself compared to what we call as a base building or a ghost building. And so the way that we work with 179D is we're gonna take your building, your self-storage, your climate-controlled self-storage. Let's just say it's a new construction project. We're going to draw it up in this IRS energy approved software that they allow us to input this information into. And in that same software, we're going to draw a building of similar size. But that new building or that ghost building, we're going to put 2007 ASHRAE standards. Okay, that's almost 20 years ago what the minimum requirements were when it comes to building construction and energy efficient systems. And when we compare our building to the ASHRAE standards of 2007, that increase of energy efficiency is going to generate another tax deduction that actually complements and goes along with cost segregation. So it's almost getting a double benefit there. You can do cost segregation studies, and then you can do 179D with the same building and even get further accelerated depreciation into that year one, for more of an immediate deduction. So both studies are very similar in the way they're treated. One is accelerating more components of the building, and then 179D is looking at the size of the building, square footage of it, and the tax year it's put in service. And through a calculation and energy efficiency analysis, it will accelerate a deduction amount into year one that you can also deduct from your taxable income.
No, that's incredible. You guys bring up a good point too about the new construction versus going and doing acquisitions. What are some of the differences and nuances and things that people should be thinking about on the cost segregation side if I'm looking at just a straight up acquisition of an existing storage facility versus partnering with you guys and going through the process on like total like ground up development? What are some differences? What do the processes look like there?
Sure, the processes are the same either way. Okay, the for a new build, obviously we have greater resources of like pulling up all the different reports, the AIA reports, getting all that information on construction costs and everything. Sometimes if you've acquired a property, a facility, you don't get all that same information, so you lose a lot of that information. So it doesn't really matter when you do it. Okay, it's just more beneficial because all the reports and all the documentation that we need are more readily accessible at that stage.
And one thing to think about whenever you're doing a cost segregation on a building that you acquired or just purchased that was already existing, for 179D to work alongside that and go with it, you have to actually do renovations to that building or newly construct that building. If you just acquire a building, you can do cost segregation on it, but 170 would not be a play at that point because in order for you to claim 170, you have to be the one who incorporates those energy efficient systems or through a renovation or a new construction building. So that's the two main things. If a building is new construction or renovation and you're doing cost seg on it, you can do 179D on it. If you just acquired a building, just bought it, you can do cost seg on it, but you can't do 179D.
Gotcha. Okay. No, that's great to know. That's great to know. And let's say the previous owner, I'm acquiring a facility they've done a cost seg, they've got all this depreciation going on. Does that impact me as a new owner? As I'm coming in, I'm buying the facility, do I still get to capitalize on cost segs and do like, are they totally separate things, or how does that whole situation work?
No, the minute you buy and acquire that property, that depreciation 39-year life starts afresh. Okay. So boom, you click it day one, you got 39 years worth of depreciable assets. Okay. Depreciation you take advantage of. Okay. So it doesn't matter where in that process you're at because the clock refreshes once you acquire that property.
And then let's say on the flip side, what are some considerations that I should be thinking about day one as far as my exit? If I'm planning to refinance or if I'm planning to sell, how do cost segs impact those things?
So I think the first thing let's look at just a straight up purchase. You're not rolling forward another property, doing anything part of a 1031 or anything. Okay. It's just a brand new cost segregation study. Okay. The first thing that we do is we will get with you and sit there and ask you for 5 data points, basically. Month and year you bought the property, purchase price. Is your facility climate controlled? Climate control has a big impact, and we'll discuss that in a minute. Okay. And then was the property part of a 1031 exchange? And the 1031 exchange is nothing more than, hey, I bought a property before. I used that money, the money that I made off that, I applied it towards a new purchase. So I used it in a 1031 exchange. Because when I use a 1031 exchange money, I'm lowering the cost basis that I'm going to start my cost seg on. Just like when we do the land value, we're removing the land. Okay, we have to remove the 1031 cost basis from the past building that we roll forward on. So once we get to that cost basis, then what we do is we put it in and we come back with what we call a predictive analysis. That predictive analysis is going to show you what your personal tax benefit's going to be. We're going to give you a range from conservative to high end, and 95% of our clients come within that range. So once we get that predictive analysis back, we sit down and we review it with you. Okay. And then again, it's a quick, easy DocuSign, boom, you send us the information. We ask for a 50% deposit. Once we receive both of those, okay, we get assigned a project coordinator. So what happens next is the project coordinator will get the owner and start getting all the documentation that they have. That would be like the sale contract, if you've done an appraisal on the property, any construction costs or renovation costs you have. We take all that information in. At that same time, we're going to send one of our local people out to take pictures of the property. When we get both of those, we assemble those and we submit those into our analyst when we do what's called an engineered based study. Okay, now the reason the engineered based study is important is because that's the preferred method for cost segregation by the IRS. So we check that box. We've done over 65,000 cost segregation studies. We have never triggered an audit.
Wow.
So we follow that process. Okay. The second thing that we do, and again, the preferred method, because the IRS never comes out and commits to anything. Okay. The preferred method is that someone else, an independent source, takes the picture. So you as owners can't take the pictures and then send us the pictures. Okay, you can. A lot of DIY companies do that, but we don't. Okay, because the preferred method is an independent source takes it. So then we match those two together. Once that report is complete, we'll send it back to you. And that information gives you everything that your CPA needs to file your taxes with it. So it's a complete document.
Incredible. Incredible. That was going to be one of my questions. If and when folks should consider tying in their CPAs or accountants into this whole process, and what you guys have seen there to make sure that like everybody knows what's going on.
Right. Yeah, I think it really depends on your relationship with your CPA. Some CPAs, I mean, the owners are like with them every step of the way, and other owners are sitting there saying, man, I'm going to go blast through this. I'm going to get the tax benefit, and then I'm going to give it to my CPA and let them worry about it. Right. So I think really it depends on your relationship with your CPA, okay, and where that fits. I get calls all the time. Hey, should I, listen, we don't, as an organization, replace your CPAs, okay? We work with your CPAs. Your CPAs have over 50,000 different tax codes to worry about, right? We only focused on the building envelope itself and those tax benefits that would come out of that. So we are in tune with them. We work with them, we support them, and we provide them all the documentation that they need in order to file your cost segregation reports with the IRS.
Let's touch on, you'd mentioned something about the HVAC systems or climate control, some of those things being dynamic with these cost segs. And can you touch on why that is? What are some things that people should be considering when they're looking at facilities and cost segregations? How some of those components might be something that impact cost segregations more or less? Would love some insight there.
So what happens is when you have just straight drive up, okay, your cost segregation benefit is not going to be as great if you have climate control. Okay, because there's more things that go into climate control versus drive up. Okay, you've got hallways when you have climate control. You got interior doorways that go with that. Okay, you have interior lighting that goes with that. Those are all things that can be accelerated in some of the depreciation schedules, and the cost of that goes against, that goes into the cost basis for what we do the cost segregation study on. So all those additional costs get added in there. As a general rule of thumb, if I'm doing a traditional drive up, and let's say I have a $1.2 million property that I just bought, facility, I'm going to value the land at $200,000. So I've got $1 million cost basis. When I do a traditional drive up, I'm doing between 18 to 28%. So let's just say 22%. When I flip that and I go to climate control facilities, I'm all the way up to like 35% in tax benefits on that.
Okay.
So you see the increase on that. It's almost 10% more when we're doing climate controlled versus strict drive up.
I love that, because this is information that everybody out there can utilize to really fit their buy box and their investment and business strategy. Are you investing in storage for tax benefits, or are you investing for the cash flow, the wealth creation? Like, what is it? And being able to reverse engineer facilities and say, okay, yeah, we're going to go after climate control specifically because we get better cost segregation studies, we get all these different benefits, and then we can use that to our advantage. So really, really important information here for everybody to take away, to understand how that can impact your buying decisions and what kind of assets you're looking for.
Connor, one of the things I find in dealing with self-storage owners, they're so often focused on occupancy, rental rate growth, acquisitions, but I think the largest opportunity that we often overlook is how can we improve cash flow? What's the strategy to improve cash flow? It's right there in your building. Okay. You've already acquired it. You don't have to do anything except for a cost segregation report study. And now you're going to improve your cash flow, So I think it's something that a lot of owners need to look at. Cost segregation is not a tax loophole. It's been around for over 20 years. It's approved. Okay.
Yeah. There's no wizardry going on. If you're listening to this and there's like the whole tax loophole thing going on in your mind, get rid of that. Like, I don't know if, to me, I think there's a lot of these things that are painted as quote unquote tax loopholes by a lot of talking heads and individuals out there that want to try to paint the picture that these strategies are somehow not ethical or not legal or not these other things. But like you mentioned, you got these CPAs with 50,000 different regulations they're following. Those regulations exist. And for us to be able to take advantage of them as business owners and as people in the private sector, to go out and create industry, to provide jobs, to provide assets, and to improve areas and do these things that the government doesn't want to do and shouldn't be doing. So I'd strongly encourage anybody. I don't know if you guys have read the book, but it's funny looking back. Way back in the day, I had read Tax-Free Wealth by Tom Wheelwright. And man, I tell you what, when I first started reading that book, I had the idea of like, yeah, paying the taxes is kind of like, I want to quote unquote pay my share kind of thing. But like going through that book and realizing and understanding this total shift of mindset that no, like you're providing value in ways of X, Y, and Z, and you get rewarded and compensated for that, which is more than It's better than paying taxes. When you're paying taxes, you're getting punished.
Right.
So
Right.
that's my perspective on it nowadays. Encourage anybody to educate themselves and look at why those things exist and truly understand it. Seek to understand it. Really great point on improving the cash flow through the utilization of cost segs in the building. What are some other things that you guys are seeing that maybe self-storage owners aren't considering and that maybe that they're missing and should be thinking about, whether it's on the acquisition side, the operation side, or even when they're selling? What are some of those things?
I think the big thing is in renovations. Okay. When you renovate things, example, we do a lot of LED lighting projects. Okay. When you do an LED lighting project or you're replacing all the HVAC, not only are there's huge tax benefits when you do that. People aren't aware of them. Okay. When we do a lighting project, what we do is we include a couple different things. One, everybody gets energy reduction, right? Hey, I'm going from old fluorescent lighting and metal halides to LED lighting. Instantly 50% energy savings right off the bat, right? Some areas have rebates. Their local utility will give them $20, $30 or whatever it is, kWh reduction benefits, where, hey, reduce the load by X, you're going to get 9 cents for every kWh reduced, okay? You can go to websites, and I'm going to give this one to you for free, and it will tell you every type of rebate that's going on in your area. And the rebate is dsire.com, desire.com. Okay, it does every state in the United States. It will tell you what programs are out there that are available for you, and you can go and see what those rebates look like. Okay.
Amazing.
So what we do though, in addition to those two, you get what's called partial asset disposition. The IRS says that if you throw away things that still have a useful life, okay, and if I've just bought a property and I start my clock at 39 years depreciation, and after year 9, I'm going to do a lighting project, I get to accelerate the remaining depreciation on those lights, the next 30 years on those lights, and take that as a one-time expense the year I do the project. That cost or that tax benefit is normally 10 to 20% of the total project cost, back in partial asset disposition alone. Now, the key to that is you have to take that the year you do the project. You can't go back, oh, I did a lighting project 2 years ago, I want to go grab it. No, you have to take that tax benefit the year you do the project. The other thing is there's a thing called QIP, Qualified Improvement to the Property. When we do QIP, and that's for the new products that are going in, when we do QIP, that can be anywhere from 30 to 50% of the total project cost back in tax benefits. Okay. So when I do a lighting project, I'm taking partial asset disposition for the things I've thrown away. I'm taking QIP, Qualified Improvement of the Property, for things new products that I'm adding. I'm getting 40 to 60% right off the bat in tax benefits. That's before I add energy savings and any type of rebates. So that to me is one of the biggest things that people overlook. Same with doors. And if you're going to do a Janus door project, okay, and you've got old doors you're throwing out, those still have a useful life. You can accelerate the remaining depreciation on those items and take them as a one-time expense the year you do the project.
That's wild. Even though you're taking them out, they're not even there anymore.
We call it cash in the trash right there.
I love that. We need to get a CSSI shirt with that on there, man.
There you go. I like
Cash in the
that.
trash.
I like that, Connor.
Yeah, get it made. That's absolutely incredible, man. Like, thanks so much for breaking that down, because, I mean, how many folks out there, I mean, they're just factoring in the cost of doing those improvements,
Yep.
not factoring in any kind of ROI other than maybe a little savings or something here and there, like if it's, again, an energy-based thing or something like that. They just have no idea. And those are the things, man, that like keep me up at night, where I'm like, what am I missing? Like, what are some things? Like, I know there's probably a million strategies that I could be doing that I'm not. And just having that information is just totally invaluable, because, again, all these things, being able to make that money, keep your cash, and reinvest it either into the facility or into other acquisitions or any of those things, the value there is just astronomical. I wanted to bring it back to also on the flip side of like the sale. Like, let's say there's a sale refinance. People hear the term like recapture. Do you guys want to kind of walk through what that looks like and how you've seen those things play out and what that is exactly too? Obviously, we'll probably start there.
For sure. So let's go back. And one of the things we didn't touch on early on was one big beautiful bill
Mm.
that passed last year, okay, in 2025, and it made for 100% bonus depreciation. And what is bonus depreciation? 100% bonus depreciation says that everything that we accelerate into 5, 7, and 15 years, we get to take year one. So if I accelerate $400,000, you don't have to wait for 5, 7, or 15 years to get it. You get it all in year one. The great thing about cost segregation is that if you don't use it, it rolls forward until you use it all up.
So I can use it like years down the road and help offset income and tax exposure, all those things.
Yep, exactly.
Amazing.
Exactly. Now, recapture. Recapture says that you can't do a cost segregation study on a property. Well, you can do let's say you do a cost segregation study on a property. If you go and turn around and sell that the next year, the IRS is saying like, well, listen, we just gave you $2 million worth of tax benefit. You sold the property, that doesn't work, right? So what they'll do is they'll prorate the remaining accelerated depreciation that you have taken credit for that you haven't used up and take that in a clawback or recapture. So there is that clawback. It's especially tough with 100% bonus depreciation because you're getting that number up front. However, and I learned this from another self-storage owner. This was early on in my career down in, this one is in Vegas. I remember it specifically. He came up and he said, listen, he said, I don't do 1031 exchange. I don't worry about the recapture because guess what? I'm going to get that money. And let's say I'm going to get that money on my 2025 taxes, but I'm not going to have to pay that recapture till 2027 when my 26 taxes are due, right? So I'm playing with house money for a year. What can I do with all that money for a year? Time value of money says money is more important now, more valuable now than it is from a year from now. But he said, I don't even worry about that because once I sell that property, I'm either going to go buy 2 properties or a bigger property, and I'm going to do another cost segregation study, which will give me all the tax benefits there, plus pay off my recapture fee. So all he's doing is paying it forward. So interesting perspective about that. And that one, I really took that one to heart because that's something that I never thought about. I always try to tell people, oh, the recapture fee is big and stuff, and don't do it if you're not going to hold it for at least 5 years and everything. He goes, why? I'll play with their money for 3 years, right?
Yeah.
Invest, do renovations, build up the valuation of my properties, add more facilities. I'll do that. And then I'll pay a recapture fee because I'm going to do cost segregation studies on all those other properties.
How do you recommend folks to walk through this process to understand like that the business strategy as they're going through it? Should they be meeting with you guys and meeting with their CPAs and walking through these things and saying, hey, like, this is my strategy. These are the things I'm thinking about. Like, how would you coach somebody to walk through a lot of this stuff to put these pieces together? Because there's so many amazing things.
So that's one of the things that we do at CSSI, excuse me. We offer free consulting. So if you ever have a question or anything like that, you just call us. We'll give you the answers, okay? And listen, and I've told this before. I said, you don't need me on this. They just did a renovation. You don't need me to do anything. Just tell your CPA, make sure he should be able to capture all that. But we look at each situation independently of itself. Connor, earlier, as I was sharing a story with you, I met this guy at SSA back in like 2022, and he was just looking at getting into the industry, right? And became friends with him and everything. And he was saying, Brian, this year I'm going to do it. This year I'm going to do it. This is the type of facility. This is what I can afford on my budget. So I started running preliminary numbers for him on what a cost segregation study would look like and how that would impact him financially, right? Okay, great. He had 2 of them on the line. Both of them fell through. Finally, at the end of last year, he was able to secure one. He was able to close it. And in January, we did his first cost segregation study with him. So all you have to do is call us. We can run predictive analysis for you to show you what that tax benefit would look like. And then at the same time, we would do consulting with you.
Fantastic. No, because that's such a huge benefit. And because again, we just don't know what we don't know, right? And until we're talking to the experts that have seen it 100 times, and I mean, how many thousands of cost segs have you guys done?
65,000 cost segregation studies.
That's crazy. Yeah, I mean, these folks that have done it 65,000 times, that's so many different examples and so much just information and data that you guys know that nobody else is going to have. So just huge amount of value. I wanted to touch on, it's probably difficult. Like if somebody's out there and they're trying to figure out, outside of just reaching out to you, is there any kind of like just average or ballpark cost that these things generally look like? Or is there like a square foot, like, can I say, oh, my facility's 100,000 square feet, all traditional drive up, like what would it cost me to do this cost seg? Is there any kind of formula out there that people could use, or is it just like, hey, like reach out to us and it's a case by case thing?
It's a case by case thing, honestly. Yeah.
Yeah.
So for example, if you have all drive up, that's going to be a less expensive cost segregation study than if you have climate control. Okay, because there's more things for us to look at, more things for us to pull apart to find out what those costs are and build up the study, get those costs all put together. Okay, it takes more time to do a climate control because of all the intricacies. Hey, you've got the HVAC systems yourself, you've got ventilation, you've got all the things that go with it, ductwork and everything. All those things can be accelerated that a normal drive up doesn't have. So that's why climate controls are going to be more expensive than your traditional drive up.
And something that's coming to mind too, are there any states out there that have made it more difficult to do cost segregations, or that doesn't make as much sense? Or is there anything at the state level that really impacts what you guys are doing that people should be considering?
Yeah, and that's a state by state basis. Okay, so what happens is a lot of them say, okay, hey, look, if you're reducing your federal tax liability, then we're going to add that as income to your state taxes. So they'll kind of play it back on you a little bit. There's not a lot of them, but there are some out there that will do that.
Yeah, no, it's something that came to mind. I was like, I'm sure, again, like we were talking earlier, they're trying to get their pound of flesh anytime there's anything going on. So
right.
Really important stuff. What are some things that we should be thinking about? What are questions that we haven't hit on yet today? The considerations that owners, operators, buyers, sellers, any of that stuff that you guys can think of, it's like, this is really important and people should be paying attention to this.
I think one of the things, maybe, Brian, let me jump in there, is just because you've built a building several years ago or renovated something several years ago, you haven't missed out on it yet. With regard to cost seg and 179D for building owners, for self-storage owners, if they constructed one back in 2016, or 2010 or 2022, whatever it is, we can actually look at buildings that are put in service or renovated in prior tax years, and we can still catch up that deduction on a current tax return. So there would be no amending. It allows for us to do that through a 3115. Now, some things you do have to consider, though, is that, if you had a building that you newly constructed in 2010, and let's say, just for simplicity, that the cost seg deduction was 100,000, accelerated, and so was 179D. So it's like a total of 200,000 in deductions that could have been accelerated back when you put that building into service. But you've also been depreciating that building for 15 years out of that 39-year lifespan. So we would have to account for what's already been depreciated. So if you would have gotten a $200,000 deduction back in 2010, if you would have done the studies when they were put in service, you would have gotten that full deduction and that benefit at that time. But now that we're taking it 16, 17 years later, we're going to have to account for what's already been depreciated. So maybe the deduction only might be 60% of that amount, but it's still a deduction. It's still stuff you get to accelerate, into the current year. So one of the things I would think about is that just because it's something that's put in service and you think you might have missed it because that tax year is closed, that's not the case. You can actually catch that up with a 3115 change of accounting form on a current tax return.
Incredible. Okay. And that's just specific to the 179?
And cost seg.
And cost seg.
Both of them.
I think one other thing on 179D too is that this gets a little tricky, but if you started construction on a climate controlled facility, okay, prior to January 1st, 2023, okay, and completed construction on that after January 1st, 2023, you're eligible up to, Brian, was it $5 and?
It depends on the code reads $5, but it adjusts each year for inflation. But if you start a building new construction or renovation prior to, let's just say, January 1st of 2023, to simplify it. If you started in December of 22 and you finish at any time after January 1st of 2023, the 179D deduction is based on the square footage, and the tax year is put in service and can be anywhere from 535 a square foot. That's for 23. For 24, it's 565, and for 25, it's 581. So, think about that per square foot. If you have a 100,000 square foot building, you're looking at over $500,000 deduction, all of it in year one. Whereas cost seg does break it out into multiple years, and depending on whether there's bonus in those years or not, 170 is always accelerated into year one for an immediate, benefit.
Incredible. Are there any nuances with, let's say I bought a facility that had these improvements done, prior to me owning it? Is there any kind of benefits there that people can take advantage of, or is it just strictly, hey, my 39 years starts now and I can do accelerated depreciation, all these other things?
So whenever you have let's just say a developer, develops a self-storage facility, and his idea is to, build it and then sell it off right away. If he builds it and it's climate controlled, and everything is installed and it's ready to go, and day two, once it gets its certificate of occupancy, that day two, he turns around and sells it to a new developer or a new owner. The new owner can't take 179D deductions because they're not the ones who installed those energy efficient systems. The guy who originally built it is the one who did that. So they wouldn't be able to take that benefit. If he kept the building, then he would be able to take that benefit, the original builder. With that said, though, even though you may not be able to do 179D, that new owner will have a new 39-year basis. So he'll be able to take cost segregation and accelerate those building components.
Connor, just to let you know the impact of that. So I had a guy, he had a couple self-storage facilities up in North New York, up by Buffalo and everything, right? One of the properties, and they were both climate controlled. One of the properties he had started and finished before 2023, okay? And we were able to get him $50,000 179D benefit. He had another property that he started before 23 and after 23 finished it, over $400,000 in tax benefits, okay? As a result of 179D, the impact of just that timing difference, okay, and what that has to do.
Oh, that's amazing. That said, if I'm out there, I'm looking at acquiring facilities I own or I'm building, whatever, how do folks get in touch with you, man? How do people get in touch with you and start the ball rolling on taking advantage of these things?
Sure. Yeah. Feel free to give us a shout. I can give you my cell phone number. Give me a call, 714 area code 345-7337. You can also email me at Brian, BRIAN Liles, Liles, at CSSIservices.com.
Fantastic. That sounds great. We'll make sure that those are in the show notes for everybody.
Perfect.
And guys, thanks so much again for coming on today, discussing these things. Is there any just last tidbits of wisdom, advice, any of that stuff that you guys have before we wrap up?
I got one more for you, okay?
Let's do it.
And it involves succession. Many of the owners that I talk to are getting up in age and everything, and their plan is to leave the business, leave the self-storage facilities to their family, to their sons, to their wives and everything. I did, a gentleman had 23 different properties, okay? He was like 78 years old, okay? Did a cost seg study for all 23 properties. I don't know, it was almost $6 million worth of tax benefits for him. In his will, it was bequeathed to the children, right? He passed away a year and a half later. Quick death, okay? But there's no recapture and cost segregation for death. So the kids took ownership. They had their step up in basis for the new cost, and they were able to do a cost segregation study right away on the property.
That's amazing.
It created a whole new set of cash at over $8 million worth of tax benefits back to them with their step up in basis and everything. So as you're out there and you're succession planning, figuring out what you're going to do, don't be afraid to do cost segregation. Do cost segregation, okay? And allow to be passed and generationally be able to take advantage of it.
Total life-changing scenario there, especially going through a situation like that. And man, what a great tidbit to know and understand too. Because that succession and estate planning piece is huge. Again, that's another big reason that we all get into these things is that generational wealth and resources aspect that we want to make sure our families are taken care of, whether we're here or we're not. So, no, incredible. Man,
Exactly.
you guys just have so much stuff. So exciting. Again, appreciate you guys coming on. Thanks so much for everything. Everybody out there listening, get in contact with these guys. Don't sit on it. Reach out to them today. Make sure that you're taking advantage of these things, and get out there, make things happen. And Brian, we'll see you guys on the next one.
Thanks, Connor.